Welcome back and welcome to another episode of Market Grinders. I'm Anthony. Today I'll be talking to you guys about balance sheets. What is a balance sheet and how do you understand a balance sheet? I'll do my best today to try to break this down for you guys. So, first of all, what is a balance sheet? A balance sheet is a financial statement that shows a company's assets as well as a company's liability. What are assets and what are liabilities? Assets come in about three different categories for a company. One would be current assets, things like cash on hand, cash in the bank, stock. Other things are like fixed assets. Sorry, those would be things like the property that the business owns, the equipment that the business owns, inventory that the business owns. Other things are intangible assets. Those are things like trademarks, copyrights, things of that nature. Liabilities. Liabilities are things that the company owes, and they fall in some of the same categories as your assets. You got short-term and long-term liabilities, just as well as you have short-term and long-term assets. A short-term asset is an asset that you plan on turning liquid within 12 months. And what I mean by liquid in financial terms, liquid will be cash. Like I plan on turning this into cash within 12 months. Long-term assets are things that I plan to hold on to for more than 12 months. Liabilities. Short-term liabilities again are liabilities that I'm responsible for within the next 12 months. Long-term liabilities are things that I'm responsible for past the 12-month period. So some liabilities are bills, payments, debt, things that you have to payments and fees that you have to take out of the cash that you bring in order to keep your business running. So operating expenses are considered liabilities. So why is it important to understand a company's balance sheet? Because a balance sheet actually shows the amount of equity left in the company. So you can look at company XYZ and they could tell you, hey, we're worth $5 billion. You have to be able they have to be able to show that on paper that they're worth $5 billion. And the way that they show that is in showing the amount of assets that they have and the amount of liabilities that they have. So now they take the liabilities and subtract them from their asset, and that should equal $5 billion. If it doesn't equal $5 billion, that company's not worth $5 billion. So those are the things that we need to dig into when we start to looking into our companies a good investment, or are they at a good price. So you can look at two different companies in the same sector, meaning that they perform they sell some of the same goods, they perform some of the same tasks, and look at their worth. Look at their balance sheet. There's a lot of information on the balance sheet. What I've broken down to you guys is just the simple version of how you should think about a balance sheet. But there's a lot of information on the balance sheet, and the balance sheet will show certain segments in time. So your balance sheet should be changing every quarter, every year, every month. But mainly from a Wall Street reporting standpoint, your balance sheet that you'll have a 1 year, 2 year, 3 year, 4 year, up to you can go back to the inception of the business looking at their balance sheet. You can also look at quarterly reviews of a balance sheet to see if the company is showing a progress, meaning that they're gaining in value or declining in value. So before you put your money into a company, that would be my recommendation. First, take a look at their balance sheet. See what this company is truly worth. See if this company is increasing in value year over year. And if they're not, dig into the balance sheet and understand why. Sometimes a company could not be increasing in value because they've invested a lot of money in research. So that takes off their bottom line, but that research could turn into another asset that the company acquires and increases their net worth over time. So those are just some of the things that you should think about when you're looking at investing in the company.